Welcome to Kenya Forex and Financial Hub. So here we are going to mentor you how to turn markets moves into profits. So the first thing that we're going to do today, we are going to learn about the Asian session model. So I know most of you people have been asking about the Asian model, which is the easiest model to trade compared to any other model. So for us, we trade Nasdaq, which is also called NAS 100 in maybe our brokers, our forex brokers, we call it NAS 100 or US Tech if you are using XNES. If you are using Paperstone, that is US 100 or NAS 100. So I'm going to break it down very fast. So first of all, welcome to Kenya Forex and Financial Hub. Here we teach you how to make money from the markets. So no a lot of issues, no a lot of discussions, just direct making money. Okay, so I'm going to start from the daily time frame. So here we can see the market is on a downtrend. So I'm going to base my analysis on the 15-minute, then and the 1 minute for entry. So remember one thing, time is very important in trading. Time is very important in trading. So make sure you note down the time. So remember, when we are trading the Asian model, the time that the market always we prefer you trade is between 1950 and 20. That is the New York time. Remember, that is New York time. That is like I guess that is around 3 in the morning. 3 in the morning in Kenyan time or East African time. So I'm going to look in my charts around that specific time. So you're going to base your analysis only in this time window. So between when the market opens at 1800, so you're going to base your analysis between 1800, so that is you can put a vertical line there, and 21. So make sure by 21 all your trades are closed. You don't have to be holding trades after that time. So what we're going to do is inside here we're going to notice which liquidity has not been taken out or which liquidity has been taken out. So if we see here the market opened, it went up, taking out this liquidity, came down, it started going down, then started going up. So and remember, on the daily time frame the market is on a bearish trend. So what do you expect? We have to align our analysis according to the daily time frame. So what we're going to do here, we are going to come to the market at a specific time, very important. The specific time that we come to the market is 1950. Remember, we are trading the macros. For those people who don't know the macros, you learn that in our class. You can maybe apply for our mentorship program and you are going to learn about that. So the macros, these are specific time window when the algorithm, remember this market is being moved by an algorithm. It doesn't move just randomly. I know most people are saying the market moves by buying and selling pressure, but that is not the right thing. So the market moves using an algorithm that is set in the market, and there is this specific time where the market spools. What I mean by spooling is the market really goes to maybe a certain liquidity or a certain inefficiency to fill it. So these things you're going to learn once you come into our mentorship program. And remember, we are offering mentorship program online classes at just 15,000 for 3 months, a period of 3 months. You're going to learn all these models. You're going to learn how to trade the Nasdaq profitably, how to master risk management, how to master trading psychology, all those models. We have the Asian model, we have the London session, we have the New York pre-market session, we have the New York open session, we have the silver bullet, we have the final hour macro that is happening around 10:15 Kenyan time to 10:45. So if you're somebody who is working during the day, you can always maybe focus on the final hour macro, which is very simple. If you're somebody who is doing forex as a full-time career as for us, you can focus either on the New York open or the pre-market session. If you're somebody who is always going to work the entire day, you can always focus on the Asian model because it just happens at between saa 9 and saa 10 Kenyan time. So I'm going to call this macro macro. Yeah, so that is between 1950 and 2010. Sawa sawa. So at this specific time, I'm expecting price to have a reversal. Sawa sawa. So at this specific time, I'm expecting three things. Number one, grab of liquidity, then reversal, then an inefficiency. Then the market once comes back to the inefficiency and fills the inefficiency, that is when now I am expecting to take my trade and target the opposing liquidity. So if you're in this market, where do we have liquidity? First of all, we have liquidity here. Yeah, that is buy side liquidity. So I know you're wondering, why do we call it buy side liquidity? You'll learn these things once you come to our forex class. Remember, we don't have a lot of we don't talk a lot of things. We just focus directly on what has brought you here to make money. Sawa sawa. So we have the buy side liquidity and we have the sell side liquidity. Which other liquidity? Before this 1950, we had this liquidity here. So the market came down, swept that liquidity. So this is a sweep. This is a sweep. You can see the wick. It just wicked. That is called a sweep. Sawa sawa. This is a sweep. Then the market went down aggressively. And this aggressive movement, what does it indicate? It indicates that the market is now wants to go lower. So this fair value gap, you can see the market is really respecting. So for somebody like me who has backtested this strategy and I know it works, I'm going to take my trade here and target this liquidity. But somebody, let's say for example, you are not that much confident in this trade, you can still wait, because remember, the market will always give you the story, will always give you the signatures where it wants to go, you know. So at this specific juncture, what you're going to do, there's always two things. We always say that the wicks does the damage while the body tells the story. So remember, anytime the market is going down or up in any PDRAs are like the fair value gaps, the order blocks, the breaker blocks, all those, the market must always respect the top of the 50%. Let's say for example we are going bearish. I want you to see here, we are bearish. Check here, the 50% is being respected by the bodies. Remember, the bodies tells the story. So if the market wants to go lower, it will respect the 50%. Let's say the lower 50% if you are bearish and the upper 50% if you are bullish. So check this, what happened. The market came in, the wicks were just going above the 50%, but the bodies were staying inside the lower quadrant of the 50%. Then it sent price down. So what do we expect? Below the loss, we expect below the loss, speed below the loss, because we are expecting price to go down. So this is a signature that is going to indicate for us that the market has decided to go down. So what happens? It left an inefficiency here. Look at what happened. Look at the 50%. So if you didn't take the trade in this first entry, you can take this another entry and then target now the liquidity here. That is around 40, I guess 40 pips. Let me see. So for me, I could have taken my trades here just once the market retraces back to that fair value gap and targets here. That is 50 pips. Yeah, 50 pips. A cool 50 pips just made in the morning. Yeah? Then the market came back into this fair value gap again, went down. You see, speed below the loss, speed below the loss, very fast, leaving another inefficiency, respecting the 50%, going down again. Then you can see the market now started moving very fast because it was on a hurry to take out this liquidity, you know, and that is how we closed our trade. So how many minutes did it take to hit your target? 1 2 3 4 5 6 7 8 9 10. So if you took your trade here just 10 minutes and your profits is in your pockets. So that is how you can trade the Asian model. So there is a lot of advanced knowledge that you can learn on how to trade specifically the Asian model. I'm going to show you the specific liquidity draws that you can target. For example, here, if you're somebody who your risk management, maybe you're always closing your profits in partials. Remember, that is a strategy of risk management. For example, you might enter your trade here, then make sure at 50% you close at least 50% of your profit, and also move your stop loss to break even, so that when the market reverses you don't lose anything. Already you are in profits. Sawa. So if you're somebody who is using that strategy, you can set your take profit 1 here, then close some of your profits. Then once the market goes and it hits your target, you have closed the entire portion of your profits. So this has been an inciting video, so watch it, understand it. If you want to learn more about trading, you can WhatsApp us at Kenya Forex Hub and Financial Hub. You can always WhatsApp us and get more information about this. So peace out.